Welcome to Educational Alpha. I'm Bill Kelly, CEO of CAASA Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, Bill sits down with James Burron, the Executive Director of the Canadian Association of Alternative Strategies and Assets, CAASA. James shares his insights on the alt industry and how CAASA is making waves in Canada. Their discussion covers topics ranging from James's background, adopting generative AI, the evolving landscape of diversification, the 60-40 investment strategy, and the expectations around private markets. Get ready for an informative and engaging discussion as we explore the world of alternative strategies. Listen in.
James Burron, welcome to Educational Alpha.
Hey, thanks, Bill. Yeah, it's great to be here.
My pleasure. We were together just last week at the Mishui, which maybe we can touch upon. And Claude Perron is just the dean of alts up there. And it's great to see that event running 10 times over. But maybe we can come to that in the course of the conversation. But perhaps you can introduce James to the audience at the start.
Yeah, sure. Thanks. James Burron. It's the Canadian Association of Alternative Strategies and Assets. It kind of just rolls off the tongue. So we call it CAASA, which we think is pretty inviting, pretty friendly, which is kind of what we are. I mean, we're based in Canada here, of course, in Toronto. And I guess to some degree, your typical trade association, we have quite a few members, 375 now, and spanning the alts industry from basically PE, venture, real estate lending, hedge funds, which is kind of my background. It's a bizarre resume if you've looked at my LinkedIn. Some of the younger folks say, wow, it's great you have all this experience. I'm like, yeah, try to explain yourself to a recruiter. But it's great for this because our members are pension plans, family offices, broker-dealers, asset managers, accountants, lawyers, fund admin. So I guess if I have one trade, I kind of get along with everybody and can kind of know enough information to be dangerous in quite a few different areas and then deep in others. So it's just great. We've been going for 5.5 years and I'm in my 50s, so I got some time to go. This has just been a whirlwind. We've run CAASA for the last 10 years now. So you've both seen the associations grow and evolve. I think evolve is the main thing too, because you got to keep moving with the market. So that's kind of me.
Good. And you were an early adopter of our curriculum. What class year were you in for the CAASA?
Yeah, not early enough. I was in 2006. I think I'm 668. So sub 1,000 members, which is, I think, a pretty good number. And yeah, I loved it. I probably shouldn't tell people this, but I failed CFA level 2 twice. And I'm not the analyst, right? So people who are not analysts, there is a place for you in the world. It's called CAASA. And I just love the alternative side. And it was literally for me, reading The Economist, which for me is fun. So when I got into it, it was just amazing. I was like, this isn't even studying. This is so fun. So, and then being involved for the last few years as well, chapter executive, working with various committees and, just love the whole group of CAASA charter holders and candidates. I mean, everybody's kind of a nerd in the way that I might be. So it's just fun.
Yeah. Good. Well, you said not early enough, but I would also say it's never too late, given the fact I was class of 2022. So an old dog can learn a new trick as well. So a couple of themes, James. So we were just together last week, and then this Mishui is just an awesome community-wide event, not just Montreal. It seems to span most of Canada. Very interesting market, and I want to talk about some of the developments there. But it seemed like a big theme around Claude and Co. this year was the event we did at CDPQ in advance of the Mishui. And that was focusing on, I would say, sort of the next generation, opportunities, risks, et cetera. And it was all about alt data, generally speaking, but ChatGPT, generative AI. And it was pretty interesting to hear from the CTO of Bloomberg, who seems to have Mike Bloomberg on a speed dial. And they are all in on trying to figure out how to weaponize this data. But I found them disarmingly honest in terms of it's still early. and how to figure this out. But you do talk to a lot of these asset owners, service providers, et cetera. Where are we with the adoption of generative AI? And is it as perhaps a little bit of the camel's nose in the tent that I think I took away from what Bloomberg had to say?
Yeah, I think it's really early days. I mean, Claude Perron is Mr. Montreal, and he keeps threatening to fully retire in 3 years. So he just keeps going. And the Meshri's been going for 10 years. He's already planning next year. So, he just gets a great group together. And he's been doing AI conferences in Montreal the last, I think, pre-COVID. So it's been like the last 4 or 5 years. So he's been on this for, seeing it as the place to be. I think there's quite a few folks who have really gone down the rabbit hole and really embraced it and used it a fair bit. Others have a ton of data that they haven't even come close to figuring out what they have. And easy tools like ChatGPT and others, as that evolves, will allow a lot more companies to use that. I mean, I think about our database, like who do we have? We have to get a speaker in from a family office that's interested in early stage venture that's pre-revenue and in the fintech area. Who is that? If we, as you say, weaponized our database, we could actually pull out, hey, here's 5 folks that are interesting, and there's 2 of them in Toronto and 2 in New York and 1 in Saudi Arabia. So that would be an awesome way to get that information versus recall or searching and getting a lot more like dialogue back and forth. So we're really early days, and I was really interested to hear about Chat PSP. So they have an internal Chat GPT sort of thing. So they put all of their information into that. So that's amazing. Imagine diligence when you have a new manager or you think or someone that came from another manager, different people. You could put that together and it'll tell you all their backgrounds and what to look for in that. So really just aiding people a fair bit. I think a lot like self-driving, it's not there, but it can really help you if you want to stay on a straight lane. Okay. And then it'll just get better as we go along.
Yeah. And I think the point you just made with PSP, having a walled garden of data is critically important because, as we know, there's so much garbage out on Twitter and on the internet. And I think if you drop some basic questions into ChatGPT, and for listeners that don't know too much about it, it's a real thing and a real word, it hallucinates. And with great conviction, it basically makes stuff up and says it with purpose. And so you've got to make sure you understand the data. As we've said, the killer app is trust. We must have trust in the process. So maybe moving away from AI, the light's coming back on again. You and I are out there traveling quite a bit. What are some of the themes you're seeing and hearing in the marketplace around, just broadly speaking, diversification, 60-40 dead or alive, expectations around the private markets, et cetera?
Yeah, it's been a recurring kind of a secular theme that 60-40 is dead, long live 60-40, or what is the 40? Especially when rates are lower, why would you have a bond fund with any duration? Why wouldn't you have a zero duration long short credit fund? Or depending on the flavor, like the private lending and such. So, you can pick up yields, you can have no interest rate risk. There's lots of things you can do in that 40 side and also in the 60. We had 10 conferences this year, and I've gone to probably, I think, 30 or 35 around the world. And the recurring theme is that people are getting into alternatives, and they're seeing it less as that word alternatives. Yeah, maybe a better word is a complement or something like that, but it's going to be hard to get in the lexicon because everyone keeps using alternative. It's even in the name of Kaya. So I think there's been a change. We worked 6 years on the legislation for what we call liquid alts legislation up here, which is kind of like the 40 Act in the States and UCITS. It was a third out of the gate, so it was quite well tailored to the market. Not as much as, say, the Australian rules, which they can do anything. They don't even know what a hedge fund is because they can long, leverage short, and use derivatives in their mutual funds, but not everybody's there. And so alternatives are seen less as alternatives. And I guess the last point is we've seen platforms homegrown and also from the States coming up and putting alternatives onto the dealer platforms into mainstream. So not only is liquid alts prospectus-based to everyone's portfolios, but also private equity, private lending, even venture, some stuff even being the closed-end funds, which were never used in retail land. That's really changed. 5 years ago, I said, forget it. We're never going to see a venture fund, a closed-end venture fund in a retail portfolio. But now it's starting to happen. So I'd love to be proven wrong, which is fantastic. There's a lot going on there.
I think you raised an interesting point that maybe is worth taking a pause on, which is the wrapper. The wrapper does matter a lot. And I think oftentimes, certainly in the States, we have a tendency to give the investor what they want, which is liquidity on demand, but they want access to a long-term strategy like real estate or private equity or infrastructure. So I think that if we can try to structure the conversation around the importance of long-termism, that is an important thing. And that's why I think maybe a closed-end fund as an example is an interesting wrapper, because the fund does not have to raise any liquidity. And it's almost like I've seen some of these private equity offerings from KKR and I think Hamilton Lane on distributed ledger blockchain, where again, the fund does not have to raise any liquidity. So maybe the blockchain is next gen closed-end funds, but what is the typical structure for the retail investor in Canada? Is it a sort of a 40 Act type of structure with next day liquidity, or is it more the closed-end fund, or is it a little bit of everything?
So hedge fund strategies and a prospectus wrapper versus what we call offering memorandum. So offering memorandum just for accredited investors and just sold through securities dealers, which have the bulk of the money, and then the other one is prospectus, which literally anybody could buy. And it's coming to the mutual fund dealers at some point, maybe soon. But yeah, prospectus-based Canadian domiciled trust that can go into our registered plans, our equivalent of the IRAs, the RSPs, and that's trillions of dollars of that. So that opens up a wide area because, like I mentioned, like with long-short credit funds, probably not the best thing to have in a taxable account, but in your RSP, no tax implications. Great, you've got your exposure, and you're not having to pay tax on the accrued, the realized gains every year. And the main flavors lately also have been real estate, private lending. Those are growing tremendously. We've seen some of our members quadruple in size over the last 5 years. Just wow. And they're doing things that people understand. Hedge funds are a little bit tougher to explain, like capital structure arbitrage and convergence trading and such. And they might go, okay, it's produced me returns, but I'm not quite sure how. But with real estate, they can, I guess, perceive that they understand the rewards and the risks a bit more. We'll see what happens with interest rates, though. That'll change things around, perhaps. But there's just a lot more our thinking around it, too. Before it used to be you just buy mutual fund. Okay, we'll just put you in the mutual fund, and you'll have 95% correlated within certain asset classes. Not much you can do about that. You're going to have a lot of beta, and it's going to be highly volatile, and it's going to now correlate with your bonds from time to time, which is even worse. So people are getting non-correlated assets, that's a cat's whiskers right there. That's what every advisor wants, something that they don't have to worry about things dropping precipitously.
Yeah, I agree. And I think that 2022 is a bit of an aberration, not that it can't happen again, but now we're, I think, 5.5 in terms of the 10-year here in the States. But a lot of that rising from 0 to maybe 400 basis points happened in 2021. And the duration risk and what that does to your bond portfolio is an absolute killer. And now I think we talked about lower for longer around rates, and now they're going to be higher maybe forever, given the size of the deficits and the debt here in the U.S. But inflation, I think, is the big fly in the ointment, and where that settles down, maybe Jay Powell and company can fix. Time will tell, but we're not going to solve that here. So maybe, James, to turn the page, I think certainly being from Canada, I think you've written on the Maple Canadian model in the past, and our next long form piece is going to be on TPA, Total Portfolio Approach, which has a lot of the hallmarks of the Canadian model around delegating responsibility and governance and paying people appropriately to get the right talent in there. And I could talk a little bit more about what we're trying to accomplish in TPA, but maybe you could talk a little bit about the hallmarks of the Canadian model and having seen it, maybe why it works well and maybe some of the perhaps drawbacks to it too, if there are any.
Yeah, actually, I spoke for Kaya Korea in Seoul in the September 1st last year, and then had that little write-up from my slides. And so the real hallmark, for those who don't know, and we had actually Claude Lamoureux, who started this. Like the Minister of Finance approached him back in the early 90s and said, I would like you to run Ontario Teachers Pension Plan. He said flat out, no, I'm not going to do it. You're going to tell me what to do. So what do you need? Okay, no government influence. I'll report to you, full transparency. You'll know exactly what's going on, but I'm not going to buy your Ontario bonds and all these other kind of pet projects. We're investing for the teachers. That's it. And also going to be leaning into alternatives when we can. Like that back then, it was just purely in Ontario bonds and yielding a pretty good yield back then, of course. And also we're going to have talent here. And we've seen what's happened in other jurisdictions where, you have folks in for a few years and they can make a lot more in the so-called private sector, and then they do. So you need to have continuity. You need to have people with an LTIP that they're actually going to collect on, the long-term incentive plan. And among other things, there were a few other things that came on over the years. And apparently the minister just said, yeah, you got it. And then he had to figure out how to start it. So I believe in 92. And then they did in the 90s, we used to have a cap on the amount of foreign, even in pension plans at like 20%. Now it just seems ridiculous. And so he was told that we could use derivatives. We can swap out this Ontario bond return and get the S&P 500. And so we went back to the minister and said, hey, listen, can I do this? And should I do this? Is it within the spirit of the law here? And they said, yes, that's fine. So away they go. They did a swap for about $1 billion, the first one, and they went on from there. And since then, they got a ton of exposure in foreign markets, added alternatives, private equity, not as much in the venture side, at least not direct. OMERS has about $2 billion portfolio in venture, and then growth, and then other, which now they're calling clean tech, and also other PE, both directs, buying airports, infrastructure, and funds. And they've been able to produce good returns. And again, keep people, because that's key. If you have a private equity transaction and you're going to be holding it for 10 or 20 years, you need to have someone there who's not just got out of school, or it's like, thinking about their next job sort of thing. You need to have someone that has tenure and wants to keep it. I think so. It's a different model. The drawback, I think at first you have to kind of convince people that you're going to continue to do that. Because if you turn and say, oh, yeah, by the way, we're going to go back to government salaries, or we're going to, no, oh, gee, we lost the mandate, so now we're going to have to lose control, because they fiercely protect the control over the portfolio. The Maple 8, they go from 100 to 117% funded. And the Plus 2, which I call like OP Trust and University Pension Plan, same sort of playbook. Some of them aren't using as, they're not having to internalize as much as they'd like, but they are internalizing that management of funds. And that's a cost-efficient way of doing things. And it's a way to extract value from illiquid markets and places where before it was just difficult to make money because you'd have just transaction costs. Holding an airport for 50 years, you have 2 transactions. You hold it for 5 years, you have a lot more. You have like 20, right? You have to move the portfolio around. So,
well, when we think about this total portfolio approach, a lot of the hallmarks of the Canadian model, I think the Australian and New Zealand super funds, and maybe even the endowment model, the Norway model to some degree as well, all kind of come into play. But I think if we're maybe moving away from anything, and due respect to the late Harry Markowitz, who just passed away earlier this year, and he just brought so much innovation to the space, but allocating to buckets makes less sense when ultimately, and I think this is the way Swenson at Yale always invested, he has a single bogey. It's what is the university going to pull from him plus inflation? It's that simple. And he went around allocating around that single bogey. And what that leads to, and I think some of the points you just underscored, James, you're allocating vis-a-vis risk as opposed to strict buckets. And maybe an interesting real-time example we can talk about is this denominator effect. And I think if you were focused on buckets coming out of 2022, your equities drew down and you have to top that up. And the only way to top that up is probably going into the secondary market and weaning yourself off some of your private holdings when 2023 could be a pretty decent vintage year for private equity. So you've got to take a lot of different inputs. But if you're focused strictly on these lane-dependent buckets, I think for the allocator, it handcuffs them a little bit.
Yeah, that's a real shame because, like you say, some of the best vintages are when things are down. And private equity is not entirely correlated to public markets, but the exits are, because they're always going to compare what could I get in the public market if it's an 8 times multiple or an 18. So those are entirely different outcomes for the investor. And then we've done a lot with family offices. We have dozens that come to our events, and we have some private sessions with them. And they're right now, the idea is like, what's this 5%? So a lot of them are kind of thinking, you know what? I can keep my money at 5% for a couple of years, and I can buy a building that would be 50 million now. Maybe I can buy it for 20 in 2 years when things are really bad. And we're seeing some kind of thinking about like larger transactions that they can do if they hold on for a bit. So I think over the last little while, maybe it's been the summer doldrums or just people away finally after COVID's done, but there's maybe been less pickup in new money going into funds and certain assets. So because they're thinking, I'm not losing much by sitting here and I can maybe pick up something really good. Because the theme over especially the last 6 to 9 months has been, it's going to get bad. And, with private markets coming off, then they can pick up something for a song. And they don't really have that denominator effect. They don't really have they have an IPS maybe. Not everyone does. The idea of family office 2.0 where they have a professional team that's running it. There are some obviously that do, but many are pretty fluid with their asset allocations and what they're doing. And sometimes that can be the best thing because they're able to take advantage of opportunities that if you have to be fully invested all the time or you have these certain parameters, you can just be hamstrung in what you're able to do at crisis points, which can yield some of the best results going forward.
Absolutely. And I think the old saying, one person's ceiling is another's floor. And I think here, if you were underallocated to the private markets, or there might be a manager, a GP that was forever closed, now all of a sudden there's some capacity, and maybe hearkening back to our mutual designation, due diligence and manager selection is probably 80 to 90% of the game. So I think you still have to do your homework, but I think there's probably a lot more opportunity and optionality there. So James, maybe one other area to perhaps cover is maybe your member expectations and what you do about regulation and lobbying. And I don't know what your members' expectations are and how you co-join with other associations, but a U.S. phenomena clearly, but you probably have some global managers, this private market regulation brought forward by the SEC. Most GPs were up in arms over this. So I don't know if you get involved, and I'm using that as a signpost. We don't have to get into that necessarily, but do you get involved in trying to lobby for better outcomes for the GP or LP or for the industry as a whole?
Yeah, we have dialogue with regulators. Like I say, I ran AMA in Canada for 7 years. We worked on the legislation for the liquid alts, and that was hard fought. Actually, when it came out, it was very good. And then there's still a few things we're actually looking to re-engage after it's been 5 years now to say, okay, there's some things that we'd like to get fixed up, cleaned up. And instead of running on exemptive relief, which is typically done for some things, why not just make it part of the rules? It's been 5 years. So there's that. We haven't seen something really earth-shattering lately. The burden of overregulation, that was a theme for a few years. We're working on a couple things with a few member groups on, it's more of a cleanup thing right now, but what we've seen overall over the last 5 or 10 years is that although venture capital and private equity is not considered a security in Canada, so technically you don't have to be registered, which is a very big bifurcation between the two. Unlike in the US where there's a lot of crossover, here a hedge fund is basically all public markets. And then private equity funds are all privates. And they may hold a little bit of post-IPO, but it's not consequential really. Now we're seeing quite a few managers that, even though they're selling to permitted clients and such, and accredited investors, they're actually opting for some type of registration. And whether that's an overabundance of prudence or thinking ahead to at some point there may be regulations, because it's really gone toward everybody being under some sort of regulatory umbrella, which I think makes sense. I mean, there should be a level playing field and just have everybody compete on the merits of the investment and not have to worry about a lot of compliance problems. Like when you're getting your registrations, you have to produce a business plan, which is, I think, a pretty normal thing. If you don't have a business plan, like I always say, because my quip is kind of, if you have problems with regulation, you may have bigger problems. So like if you don't have a business plan and you're not able to have the working capital keep going for a couple of years without any assets, then maybe this isn't the place for you. So I think it's good to have a prudent approach to this, and overregulation can be a concern. And there's instances of that, of course. We're trying to hire them out, but by and large, they're there to protect investors, which we're all for, of course.
Yeah, and it's never a zero-sum game. And it's interesting, absent a business plan, that's the home of a SPAC, basically, a blank check company. And the SEC is okay with that, but then other things less so. And I think regulation is not the enemy. It's the guardrails of what we do, and it keeps honest people honest, clearly. And I'm not a student of this rule per se. Was there overreach and unintended consequences? I'm sure there were, but I did a blog post just yesterday on this. And over the weekend, any self-identified institution that wrote a comment letter, and I think there might have been 20 some odd of them, I read them. And it's good to know what's on the client's mind. You don't have to agree with them, but it's their money. We're serving them. We're charging them a fee. We've got to return that capital to them in a better situation in which we got it in the first place. And they were decidedly for a lot of what was talked about. And there was a negligence standard that Gensler and Co. wanted to institute versus gross negligence. And again, the industry was up in arms. But a lot of these letter writers said, hey, put aside quibbling over negligence and growth negligence. It's one, the quibbling, but you're a fiduciary. You owe me a duty of care and a duty of loyalty, and you cannot hedge that. So it's interesting. So I think we should have these debates, and that's how we get sensible regulation, but never losing sight of what's on the hearts, minds, and souls of the clients. We're here because of them. And this is an awesome industry. It can be a great capital accumulator, but the returns for us as a portfolio managers, if that's our trade, have got to be synced up with the client on the other side as well.
Yeah, they came together as a coincidence of once. They bought the portfolio, but then they have to be able to continue to deliver on it and in a way that one can do well. Because you know the maxim, like at least half of frauds come from operational problems. They just started doing stuff and no one was able to catch it. And then it just ballooned out. And we've seen that time and time again. But if you can catch stuff early, yeah. When people ask me which fund should they look at, what should they ask? I'm like, are they registered? If they're registered, it's tough. Like you can still report fraud. Don't worry. That can't always happen. But it's a lot more difficult with the registered entity. So that's always a good start. And then you can continue your diligence from there.
Yeah. And we were reminded, I guess it was last year, through cargo shorts and a T-shirt, that you've got to do your own due diligence. And I think that was a classic example of, well, you did it. No, you did. I thought you did it. No, well, I didn't do it because I thought you've got to be responsible on your own. And if you're going to rely on somebody else, you better do due diligence that they got the job done. So I think an important lesson. So James, as we move toward wrap up, we're recording this in late August. I'm not sure when it's going to come out, but like you, always look at this time of year as we approach Labor Day in the U.S. and just look at the mountain of travel and commitments I have. And on the one hand, coming out of the halcyon days of summer, I say, oh my God. But on the other hand, it's like a narcotic and I'm addicted to it. I just love doing it. I love being out there. So what's on your calendar? Where are you going to be? What are you going to be talking about? And what interests you as you look at this sort of the nearest term, Q4 of 2023?
Yeah, I'm on the road a fair bit like you. So September, probably a couple of weeks out. And then October, I think I'm home for 4 days. And I've done 5 transatlantic so far. I got a couple more coming. Yeah, London, some Middle East, a lot of West Coast, and then usually in the Caribbean and Florida in January, which is partially planned. My thing is like just continuing to get new ideas, whether it's formats for events. I got a great idea for an event in Frankfurt, of all places. They had a totally different format for involving the audience, which was great. And I always say you can always kind of figure out who is doing external funds at the pension plans. It's pretty much public. And there's a lot of like Canada, US, even at the private ones and such, or the private pensions. But family offices, they don't have a card. The name of the company is not going to be, maybe Kelly Capital. Okay, what does that mean? So it's meeting those folks and then talking to them about what we're doing up here. And we have a number of conferences and events for them, where they can get together with their peers and such. So finding family offices and then hearing what they're saying, because they don't have groupthink. If anything, it's everything but. They all have their own way of doing things. If you met one family office, I think you've actually met 0.2 because they usually don't tell you very much. But when they start getting in a group with their peers, they just absolutely love sharing stories and such. So yeah, I like to say it's a bit of a narcotic, which is probably a good thing, or in a good way, because going out and meeting people it's a never ending journey. And that continues to evolve too. Every time you go to an old region that you haven't been to for a while and things have changed. And you can kind of learn it again and see how it's rhymed with what we've known from the past. So yeah, I can't wait to continue to be on the road. It's been pretty extensive over the last 18 months already.
Yeah, and it's an important reminder, especially I think we're kind of wandered completely out of COVID, although I think down here there's other waves coming, and I know a few people that have it right now. But I think we've learned how to live with it is the bottom line. But I think nobody should embrace fully the efficiency of Zoom platforms. It brings a lot of efficiency, but you log on when it's starting, you log off when it ends, and then you go to your kitchen by yourself and get a cup of coffee. I learned so much interacting with people from various parts of the world, various ecosystems within our industry, and it's refreshing and repotting my thought process. And I think I'm an amalgamation of the many different inputs I hear. And it puts me, I think, in an awesome spot, both in learning and then also in responsibility too, because especially in my role at CAASA, it's less about what is my opinion versus what is the collective wisdom that I'm picking up. And that sort of informs my thinking, informs my views. And not everybody has to agree with me, but I do try to bring forward sort of an unvarnished, but also an unbiased view. And if I have any bias, it's to protect the end investor. So it's going to be an interesting Q4.
Yeah, for sure. I can't wait to get on the road. I've been off for like 6 weeks, except for our lovely Mashui Day. And that'll be bigger next year. So I think they already have the date out. Just a plug for Claude.
Yeah, I pity the poor pig, but otherwise it was a great event. So, James, always great to see you. Thank you for your friendship, your partnership. As a member, you do a lot for us around not only things like grading, but promoting the brand and what it stands for around the world. So I do appreciate it and stay well. And I'm sure I'll see you somewhere in the great wide world.
Oh, for sure. Thanks a lot, Bill. It's been great. We'll continue on. Thanks a lot.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the CAASA Association and subscribe to the show at caia.org. That's CAIA.org. See you next time.